Welcome into Market Takes. Look, first of all, a happy Nuggets 2023 NBA Championship Day to those of you who celebrate out there. I know I'm celebrating Denver Nuggets 2023 NBA champs. But of course, that's about yesterday. And today we are looking into the CPI Consumer Price Index reports here on Market Takes. I am Dion Rabouin, reporter at the Wall Street Journal. We are going to dive into this data, but don't forget, Denver Nuggets are 2023 NBA champions. Listen, this morning's CPI report was a big one. It's got a lot of folks in the markets excited, especially on the risk asset side. We are going to break down what it means, what the data said, what this tells us going forward. We're going to talk about what the report showed, how it compared to expectations, of course, how this sets up the Federal Reserve, because as we know, everything moves the way the Fed moves. We're going to take a look at those markets, tell you about how they're responding, talk about the biggest takeaways from this report, and what comes next. So first of all, let's throw up here on your screen this chart showing what's going on with CPI. Now, as you see there, we have seen 11 straight months of decline in the year-over-year consumer price index. That means inflation has been slowing every single month since we hit that peak of 9% in June. That's that big tall bar you see there over on your screen about the middle of 2022. Ever since then, we have seen inflation consistently come down, and then today we got a 4% reading, inflation rising 4% year over year, well below that 9% number, and below those 5% and 4.9% that we've had the past couple months. So again, that acceleration in declining, or the acceleration or decelerating inflation rate continues. That's bullish for risk assets. I want to throw another chart up here on your screen now. This is core consumer price index. That's not quite as bullish. As you see, they're holding up above 5%. The reading for this month was 5.3%. So core inflation hasn't been coming down in that same nice wave pattern that we saw for overall CPI. You're seeing the core CPI really a little bit more stubborn, holding up a little bit higher. And that just illustrating that some pieces of this inflation story are not moving the way the Federal Reserve would like them to. So this is something that's why markets, I think, were very excited when this data first came out. 4%, right on the numbers, right in line with expectations. The month-over-month change was just 0.1%. This was an exciting report for the market. But then you saw, oh, wait, hold on, let's look at that core number. And you started to see a little bit of change in the market. So that's what we're seeing right now. Overall, there were some worries as we came into this report. We had seen new home sales jump last month to the highest since March 2022. We had seen purchasing managers indexes showing business activity starting to rebound, the highest in a number of months. We had seen services be a major concern for the Fed. Retail sales last month unexpectedly picked up. So there were all things to suggest that consumers were still going out spending, that maybe inflation could be higher. But as we saw in the report today, 4% year over year, well down, continuing a string of declining lower CPI numbers and CPI increases in inflation. What were the biggest contributors to this report? Well, we saw shelter, gas, and used cars being the biggest things holding, or the biggest things moving inflation higher. Now, those all matter because, one, what do we know about shelter? Shelter has been consistently coming down according to real-time measures of the economy, but we know that CPI shelter gets fed in on a lag. So even though the shelter index is rising consistently, that's based on older data. The real-time data tells us that shelter costs are coming down. What do we know about gas? We know gas is very volatile. It moves up and down significantly. So when you get a big spike up in gas or a big move down in gas, gas actually moved down significantly. But we know that that is not one of the major pieces that the Federal Reserve looks at, because it's not something they can really control. That's more controlled by OPEC, global oil demand, things like that. That's not something the Fed can really attack or bring down. And what's that other piece? Used cars. Well, that's goods, and we know that goods prices have been well below overall inflation, coming down much faster than the overall pace of inflation. So when they picked up this month, well, that's going against the trend, and that suggests that maybe that's not something to be that worried about. So all the things that really would need to be moving in the right direction are in these things that are moving in the wrong direction, namely used cars and shelter. Real-time measures of the economy tells us that those aren't really things that we need to be worried about, and those are things that, in terms of the overall trend, are moving in favor of inflation coming back down. So big picture, inflation continues to cool, continues to come down, but it's being held up by a couple things that could go away. You don't really know. They're not things that the Federal Reserve controls. but you also have to look at that core inflation and say, okay, well, that's mostly being held up by goods, but it's staying around the same level. It's not coming down the way we'd want it to. Ronald Temple, he's the chief market strategist at Lazard. He's an investor there, chief market strategist. He had an interesting quote. I want to read it to you really quickly. He said, quote, "Another month of core CPI over 40 basis points is disturbing on the surface, but used cars and auto insurance drove nearly half the increase this month. More importantly, shelter inflation remained at a substantially lower level than recent peak levels and will continue to decelerate while other services inflation was contained. Overall, the Fed should feel comfortable with a pause at tomorrow's meeting, and its tightening appears to be working on the stickiest drivers of inflation." So that is good news because we know investors don't want the Fed to keep tightening rates, don't want the Fed to keep raising rates higher, making it more difficult for businesses to go out and borrow money, more expensive to borrow money, making those credit card rates rise higher, making those personal loan rates rise higher, those home equity lines of credit and home equity loans rise higher, get more expensive. Those things all slow down the economy, make people less likely to spend. The market doesn't want that. The market wants folks spending that money and going out there and doing those things. Speaking of, let's check in on the market right now. I want to put up here on your screen the latest data that we're seeing, what we're seeing from the market. Now, you saw the Dow after the report came out just really take off like a rocket ship. We are seeing a bit of moderation. You're seeing the S&P 500 kind of coming down a little bit, and the NASDAQ you see not quite as much exuberance as what we're seeing there from the Dow, but all up about 0.5% on the day. I think the really interesting response to this is in the bond market. What you're seeing on your screen here, this data is the 10-year yield. That's the most traded treasury, and you're seeing it just take off and spike up higher, going up to 3.85%, up about 5 basis points today, but that is a big move for the 10-year note. You're seeing the same thing on the 7-year note. Look at this, these long-dated bonds, you're seeing just a big pickup and takeoff. Now, when we go to short-dated bonds, you're seeing just the opposite. You're seeing those numbers come down, the 2-year spiking back up, but you see the 1-year, the 6-month, the 3-month, all those bonds that are really correlated to what the Federal Reserve is going to do and what's going to happen right now in the near-term future, those are coming way down. Investors saying, we want to buy bonds. We think yields are coming down and inflation coming down in the short term. But when you look at this 10-year number, that big spike, that suggests that maybe the Federal Reserve not doing as much has got investors a little spooked about what that could mean for the future of inflation and what that could mean for inflation longer term. So that's definitely something you want to watch out for. When we look over here at currencies, you're seeing the euro up a little bit. Really, it took off after that CPI data was released, and you see here a big spike higher, but it's kind of come back down after that. Really, currencies not seeing a big move after this. I think the move here in crypto is interesting because you're still seeing Bitcoin. Again, right after that report was released, Bitcoin took off, but it's coming back down. A lot of that bullish enthusiasm that was in markets has come off now, and we're seeing markets kind of come down. So really, those numbers just illustrating the overall market reaction, and markets really getting bullish and excited after that report came out. 4%, down right on the numbers. But you know what? When we look at that core number, when we really dig into the report, maybe there's not as much to be excited about. And also, as we know, stocks and risky assets have really rallied over the past week or so. Maybe, this is a bit of buy the rumor, sell the news. Well, we got the news, CPI came in as expected, and markets are saying, all right, maybe it's not that much to be excited about. But let's break down what we can expect after this report from the Federal Reserve. So the Federal Reserve widely expected to pause, as in the Fed's been raising rates ever since March 2022. The expectation coming into this meeting before we got this data or any other or a lot of data for this week was that they were going to say, hey, let's take a step back, let's breathe. Let's see the effect of what we've already done before we go about raising rates anymore. Well, this report with inflation, CPI inflation coming in at 4%, really backs the case that definitely pauses the right move, and maybe going forward, we don't need to raise rates anymore. Maybe going forward, we can just, back off and maybe even start cutting rates, which is what the market really wants and market has been pricing in. So initially very bullish for risk assets, but that core number again, putting a bit of a pin in that. The Fed expected to hold rates, according to Fed Funds Futures, at this June meeting, but then expected to raise rates in July. And interestingly, I thought with this kind of bullish CPI number, you would see the expectations for that July rate increase to really come all the way off, but you're not seeing that. Investors still expecting the Fed to raise rates next month, which I think is very interesting. So a lot is going to hinge on what we hear from Fed Chair Jerome Powell at this meeting. A lot's going to hinge on what we see from the summary of economic projections that we get from the Fed. And, this is, again, the Fed is still expected to raise rates next month, about 60% chance priced into Fed funds futures markets. So investors saying, okay, this CPI report says that you pause in June, but then you still raise in July. And then what does that set up for the rest of the year? And we're going to have to get clarification on that from the Fed, and we're really not going to know. So I think tomorrow's Fed meeting is obviously going to be highly watched. It's going to be very important what we hear the chairman say and what we see from the other Fed members in terms of how they're viewing the markets. And I think that could potentially start setting us up for a very big blockbuster July report, depending on how this other data comes in. What the Fed says will be very important in terms of how the market reads and what we can expect to see from the market going through for the rest of this year. So the biggest takeaway from this report, again, we see inflation continuing to come down. You see that 4% number well below more than half or less than half of what it was in June, and about halfway to the Fed's 2% target. Again, the Fed's target is 2% inflation, and we're about halfway there, or more than halfway there, because we were at 9% back in June of 2022. So as we sit here in June of 2023, as the Fed has already started their meeting, they've kicked it off and they're talking about this report right now, just like I'm talking to you guys about it right here. They're saying, okay, what does this mean for us? And they're looking at that core CPI number. They're looking at that overall CPI number. They're looking at the month over month change, and they're saying the folks who were in the camp of we need to pause, they are probably, feeling really good about their position right now. Folks who said, no, we need to keep raising rates, who had come out and really actively campaign for that, they're probably kind of, okay, well, maybe I'll be quiet right now. I'll be quiet, but we'll see how the rest of the data comes out. So again, tomorrow's retail sales report is also going to be very important. And you're going to want to, or sorry, not tomorrow, Thursday's retail sales report is going to be important, but we know that the big market mover is going to be tomorrow, the Federal Reserve report. The statement comes out at 2 p.m. Then we hear from the chairman at 2:30. We will be right here on Market Takes at 4 after the market closes to tell you all about what happened at that Fed meeting, what the chairman said, break down what he said, what he didn't say, what was in the statement and why it matters. So we'll be doing that all here tomorrow at 4 o'clock. I hope you'll join us. We also, like I said, get retail sales on Thursday, and then next week's housing data I think is going to be very big. Again, as this shelter component has continued to hold up inflation, if we can start to see continued deceleration and declines in some of these existing home sales numbers, if new home sales start to pull back again and move lower, that could really be bullish for the markets. And again, I think this market could have legs because the data is starting to support a lot of this bullishness and enthusiasm that's in the markets that's already been priced into stock prices. So, we could see that. Next week is Juneteenth. Happy Juneteenth. We are going to be out on Monday, but we will be back here on Tuesday to give you that report. So stick with us on Market Takes, man. We will be coming to you with all the information that you need. That's going to about wrap it up for us. But again, tomorrow, 4 o'clock p.m., we'll be breaking down that Fed meeting right here. Hope you'll join us. Listen, I'm Dion Rabouin, reporter for the Wall Street Journal. That's it for this edition of Market Takes. I hope that you'll be with us next time.